Look, I'm going to be straight with you right from the start. If you're making around 60K right now and you're watching those tech bros on Twitter talk about their 300K packages, or you're seeing LinkedIn posts about total compensation and feeling like you're missing something huge, you're not crazy. There's an actual system to this. And here's what's wild. Most people never figure it out because they're focused on the wrong metrics entirely. I spent 3 years researching this, talking to hundreds of people who made this jump. And honestly, once you see the pattern, you can't unsee it. By the end of this video, and yeah, this is going to be about 2 hours because we're going deep, you're going to understand exactly how compensation actually works, why your salary is probably just 60% of what you could be making, and the step-by-step blueprint to get from where you are to 200K plus total comp. And here's the thing I'm most excited to share with you in the final 15 minutes of this video. There's one specific career move that most people completely overlook, and it's responsible for about 40K to 60K of that jump from 60K to 200K. I've seen it work consistently, and when I explain it, you're going to wonder why nobody talks about this. So stick around because that alone is worth the watch time. Right now, you're probably thinking one of two things. Either this sounds too good to be true, or, okay, but I'm not in tech, so this doesn't apply to me. Wrong on both counts. This works across industries. I've seen it happen in marketing, finance, operations, sales, even healthcare administration. The principles are the same. Here's what we're covering. We're going to start by breaking down what total compensation actually means, because most people are leaving money on the table without realizing it. Then we're going to talk about the skill stack that companies actually pay for, not what school told you matters, but what the market rewards. We'll get into negotiation frameworks that actually work, the hidden compensation accelerators that most people miss, how to structure your career moves strategically, and yes, that big strategy I mentioned that I'm saving for the end. So here's my promise to you. If you watch this entire video and actually implement what I'm showing you, within 24 months, you should see a measurable increase in your total comp. Not a little bump. We're talking 30K to 80K more than you're making now. And if you're already at 100K, this still applies. The principles scale. All right, let's start with something most people get completely wrong. So first thing, we need to talk about what compensation actually means, because here's what I've noticed. Most people only think about their base salary. You're making 60K? Cool. But that's not what you're actually earning when you factor in everything else. Total compensation includes base salary, sure, but also bonuses, equity or stock options, 401k match, health insurance premium contributions, HSA contributions, life insurance, disability insurance, professional development budgets, and sometimes things like commuter benefits, gym memberships, or phone stipends. When you add all that up, your actual compensation could be $15,000 to $25,000 higher than your base salary. Now here's where it gets interesting. At 60K base, you might be at 68 to 72K total comp, but at 200K total comp, your base might only be $140,000 to $160,000. The rest is coming from bonuses, equity, and benefits. This is the game nobody explains to you. Think about it like this. When you're negotiating for a job and they say we can only go up to 65K on base, most people think that's the end of the conversation. But that's actually where the real negotiation starts, because you can negotiate signing bonuses, you can negotiate equity, you can negotiate performance bonuses, you can negotiate annual review timing, you can negotiate professional development budgets. Let me give you a real example. My friend Sarah was offered a role at a mid-sized tech company in 2022. Base salary, $95K. She almost said yes immediately because she was making $72K at the time. But then she looked at the total comp breakdown. The equity package was worth $30K per year over 4 years. There was a 15% target bonus, 401k match up to 5%, and they covered 100% of health insurance premiums. Total comp, $142,000 in year one. That's a 50% difference from just the base salary number. But wait, here's what most people miss. Not all compensation is created equal. Cash is king. Equity is speculative. A 100K base salary with a 20K bonus is more valuable than a 90K base with 30K in equity, because the cash is guaranteed and the equity might be worth nothing if the company doesn't do well or it's not liquid. So when you're comparing offers or trying to figure out where you stand, you need to think about the liquidity and certainty of each component. Here's my framework. Multiply base salary by 1.0, it's guaranteed. Multiply annual bonus by 0.85, accounting for performance risk and company performance. Multiply equity by 0.5 to 0.7 depending on the company stage, 0.7 for public companies, 0.5 for late-stage startups, maybe 0.3 for early stage where it's basically a lottery ticket. Now, let's talk about the 60K trap. When you're at 60K total comp, you're usually at a company that doesn't offer much beyond base salary and maybe some basic benefits. Small companies, startups without funding, nonprofits, agencies, they often can't compete on total comp because they don't have the structure or resources. So your first strategic move is understanding that to break out of 60K to 80K range, you often need to move to a company with a mature compensation structure. This is controversial, but I'm going to say it anyway. If you're at a company that can't pay market rates or doesn't have a structured compensation philosophy, you need to start planning your exit. I'm not saying quit tomorrow. I'm saying begin building the skills and network to move within 12 to 18 months. Because here's the brutal truth. Loyalty doesn't pay in this market. The data shows that people who change companies every 2 to 4 years earn 15 to 20% more over their lifetime than people who stay at one company for 10 years.
Let me share some actual numbers. According to a 2023 study by PAVE, the average tech worker sees a 14.8% salary increase when changing companies, compared to a 4.2% average raise when staying at the same company. In finance, ADP's workforce report showed external hires earn 18 to 20% more on average than internal promotes for the same role. In marketing, similar patterns. Rocket Half's 2024 salary guide showed that job switchers averaged 12 to 18% increases. So the math is simple. Stay at one company for 5 years and get 4% annual raises, you go from 60K to 73K. Switch twice in 5 years with 15% increases each time, you go from 60K to 79K after the first move, then to 91K after the second move. That's 18K more per year. Over a 30-year career, that compounds to hundreds of thousands of dollars in difference. But here's where most people screw this up. They think any job switch is good. Wrong. Strategic job switching means every move increases your skills, your network, your title, or your compensation by at least 15%. You're not just jumping for jumping's sake. You're being intentional. Actually, let me rephrase that because I don't want you to think I'm saying become a job hopper with no loyalty. What I'm really saying is this: be loyal to your career growth, not to a company that would replace you in 2 weeks if they needed to cut costs. Your loyalty should be to yourself and your family's financial security. So how do you know if you're being underpaid right now? Here's the quick test. Go to levels.fyi for tech roles or Glassdoor and PayScale for other industries. Look up your exact title and your city. If you're more than 15% below the median for your experience level, you're underpaid. If you're more than 25% below, you're being massively underpaid, and you need to address this within 6 months. Here's what changed my entire perspective on this. I was talking to a friend who's a recruiter at a FAANG company, and she told me something that blew my mind. She said, "We have a compensation band for every role. If someone comes in asking for the bottom of the band, we give it to them. If someone asks for the top of the band and can justify it, we give them that. Same role, same work, but a 30K difference in comp just because one person asked and one didn't." That conversation happened in 2021, and it fundamentally changed how I think about compensation. Because here's the thing, companies aren't trying to screw you over. They're trying to pay the minimum they need to in order to hire you. That's just business. So if you don't ask, you don't get. Remember when I mentioned there's a big strategy on saving for the end? This foundation is crucial to understanding why that strategy works, because once you understand that total compensation is negotiable, that companies have ranges they can work within, and that your current company might be structurally unable to pay you what you're worth, everything else starts to click. One more thing before we move on. I want you to do something right now. Actually pause and calculate your current total comp. Take your base salary, add your annual bonus from last year, add the value of your equity if you have any, add your 401k match, add what your health insurance costs if you had to buy it yourself, probably $400 to $800 per month for single coverage, $1,200 to $2,000 for family. Add everything up. That's your baseline. Write it down, because we're going to build from this number to show you exactly how to get to 200K total comp, and you need to know where you're starting from. All right, next section. Let's talk about what actually makes you valuable in the market. Okay, so here's something that's going to piss off a lot of HR people, but it's the truth. Your job description has almost nothing to do with what you should actually be learning or what skills will make you valuable. I learned this the hard way. When I was earlier in my career, I was so focused on being good at my actual job. You know, the stuff in my performance review, the tasks my manager assigned me, and I was good at it. I hit my targets, I got meets expectations on my reviews, and my salary went from 54K to 57K to 61K over 3 years. Then I met this guy named Marcus at a conference. Same industry, same years of experience as me, similar educational background. He was making 115K. I'm not kidding, more than double. And when I asked him what he did differently, his answer changed everything for me. He said, I stopped doing what my job description said and started doing what the market pays for. Here's what he meant. The market doesn't pay you for effort. It doesn't pay you for hours worked. It doesn't even really pay you for output. The market pays you for leverage and impact. Specifically, it pays you for your ability to either make money, save money, or make someone else's job easier at scale. Let me break this down because this is crucial. There are 3 types of skills in any profession. Operational skills, the stuff you need to do your basic job. For a marketing person, this might be knowing how to use email software or social media platforms. For a software engineer, it's writing basic code. For a finance person, it's Excel and financial modeling. These are table stakes. Everyone has these. They don't differentiate you. They might get you from 40K to 65K, but they won't get you past that. Specialized technical skills. This is deep expertise in your domain. You're not just competent, you're excellent at the core work. You know the advanced features, you understand best practices, you can solve complex problems in your area. This gets you from 65K to 100K. You're valuable to your team and your company. But leverage skills, this is the game changer. These are skills that multiply your impact. Things like hiring and managing a team, creating systems and processes, strategic thinking, cross-functional leadership, communication that influences decisions, analytical ability to find insights others miss, and here's the big one, the ability to understand and speak to business impact in terms of revenue and cost. Most people spend their entire career getting better at operational and specialized technical skills. They become the best designer, the best analyst, the best whatever, but they hit a ceiling around 100K to 120K because they can only do so much themselves. The people making 200K plus, they've mastered leverage skills. They can manage a team that does the work, they can build a system that does the work, they can make decisions that affect the work of dozens or hundreds of people. They can walk into a meeting with executives and say, if we implement this strategy, we'll increase revenue by $2.3 million over the next 12 months with $400,000 in additional spend, giving us a 5.75x ROI.
See the difference? One person is doing the work. The other person is creating leverage that multiplies impact. Now, here's what nobody tells you when you're trying to build these leverage skills. You can't just tell your manager, I want to work on strategy now, or I want to manage people. That's not how it works. You have to create the opportunities yourself. Here's the playbook. Step 1. Become undeniably excellent at your core job first. You need to be in the top 20% of performers in your current role. This usually takes 12 to 18 months if you're focused. You can't skip this step because nobody's going to give you leverage opportunities if you can't execute the basics. Step 2. Identify a problem that's costing your company money or time. Look for inefficiencies, bottlenecks, or gaps. The key is finding something that matters to leadership, not just something that annoys you. Step 3. Propose a solution that involves you leading it. Don't just complain about the problem, come with a plan.
I noticed we're spending 20 hours per week on manual data entry for X process. I've researched automation tools, and I think I can reduce this to 2 hours per week. I'd like to take ownership of implementing this over the next 8 weeks. Now you're building systems skills and demonstrating initiative. Step 4. Document everything and measure impact. When you complete a project, quantify the results. Implemented new system that saved 18 hours per week, about $45K annually in labor costs, and reduced errors by 72%. Put this in your LinkedIn. Put this in your resume. Put this in your next performance review. Step 5. Repeat every 6 months. Each time, take on something slightly more ambitious that touches more people or has bigger financial impact. Let me give you a real example of this in action. I know someone named Taylor who was a mid-level product manager at a SaaS company making $82K in 2020. Good at the job, but stuck. Here's what Taylor did. Month 1 to 2, noticed that customer onboarding took 45 days on average and about 18% of new customers churned before fully onboarding. Did the math. At an average customer lifetime value of $85K, the company was losing about $2.1 million per year in churn during onboarding. Month 3, created a proposal to revamp the onboarding process. Included benchmarks from other SaaS companies, a rough timeline, and estimated impact. Positioned it as, I'd like to lead this initiative as a cross-functional project. Month 4 to 7, got approval. Worked with engineering, customer success, and design. Implemented new onboarding flow with better in-app guidance and proactive support. Month 8, results came in. Onboarding time dropped to 28 days. Churn during onboarding dropped to 11%. Financial impact, approximately $950,000 in retained revenue annually. Month 9, updated resume and LinkedIn with this project. Started getting recruiter messages. Interviewed at 3 companies. Month 11, accepted offer at a larger SaaS company as a senior product manager. New total comp, $145K base plus $30K target bonus plus equity worth about $40K per year equals $215,000 total comp. That's a $133,000 increase in less than a year. Not because Taylor became dramatically better at product management, because Taylor demonstrated leverage and business impact. Here's what's crazy, though, and this is something I wish someone had told me earlier. You don't even need to wait for permission to build these skills. You can start developing them right now, today. Want to get better at strategic thinking? Start reading your company's quarterly earnings reports or business updates. Understand how your company makes money and what initiatives leadership cares about. Listen to earnings calls. Read 10Ks if you're at a public company. Want to get better at communication and influence? Start documenting your work in terms of business impact. Every time you complete something, ask yourself, how did this affect revenue, costs, or efficiency? Practice explaining your work to someone outside your department. Want to get better at managing people? Offer to mentor someone junior. Start a working group on a topic you're knowledgeable about. Volunteer to lead a small project with 2 or 3 people. The beautiful thing about leverage skills is they transfer across industries and companies. Technical skills are specific. Knowing Salesforce doesn't help you if you move to a company using HubSpot. But knowing how to lead a cross-functional project, how to communicate ROI to executives, how to hire and manage a team, those work everywhere. And here's something subtle but important. Once you have leverage skills, you become less replaceable. Because it's relatively easy to find someone who can do a specific task. It's much harder to find someone who can lead a team, interface with executives, and drive business impact. That's why companies pay more. Let me tell you about the skill that changed everything for me personally. I learned how to do basic financial modeling and business case analysis. I'm not talking about becoming a financial analyst. I'm talking about being able to open Excel, project costs and benefits over 12 to 24 months, calculate ROI, and present it clearly. This one skill has probably been worth $80,000 to $100,000 in comp increases over my career because it allowed me to have business conversations instead of just task conversations. You can learn this in about 40 hours. There are courses on Coursera, YouTube, or Udemy. The basics are not complicated. Revenues, costs, NPV, ROI, payback period. That's it. But once you can speak this language, you're suddenly in a different category of employee. Okay, wait. I should probably mention something important here. I'm not saying technical depth doesn't matter. If you're a software engineer, you absolutely need to be great at coding. If you're a designer, your design skills need to be strong. What I'm saying is that technical depth gets you to 100K, but leverage skills gets you from 100K to 200K and beyond. Actually, there's one more category of skills I want to mention before we move on. Platform skills. These are specific technical skills that happen to be in very high demand right now. Think data science, machine learning, cloud architecture, security, certain programming languages. If you have deep expertise in a hot platform skill, you can sometimes jump straight to 150K plus even without leverage skills, because the supply-demand imbalance is so extreme. But here's the catch. Platform skills have a shelf life. What's hot today might be commoditized in 5 years. I've seen this happen with so many technologies. So if you're going to invest in a platform skill, make sure you're also building the leverage skills that will last.
I'm saving one specific skill for later in this video. It's part of that big strategy I mentioned at the beginning. But just know that it combines technical skills, leverage skills, and market positioning in a way that's incredibly powerful. We'll get there. For now, here's your action item. Look at the top 3 skills you're currently developing. Categorize them as operational, technical, or leverage. If more than 2 are operational or technical, you need to add at least 1 leverage skill to your development plan within the next 30 days. All right, let's talk about how to actually get paid more for these skills. Chapter 3. The Negotiation Framework Nobody Teaches You. How to add 15K to any offer. So, we need to talk about negotiation because this is where most people leave the most money on the table. And I'm not talking about the basic can you do better stuff. I'm talking about the actual framework that consistently adds 10K to 30K to job offers. Here's the thing that most people don't understand about negotiation. By the time a company makes you an offer, they've already decided they want you. They've spent weeks or months recruiting, interviewing, and evaluating. They've said no to dozens or hundreds of other candidates. The hiring manager has probably been dealing with an open role for months and just wants to fill it. They're emotionally invested in getting you to say yes. This means you have way more leverage than you think, but most people don't use it because they're scared of losing the offer. Let me tell you something that will change your perspective. I've talked to hundreds of hiring managers and recruiters, and I've asked them all the same question. Have you ever rescinded an offer because someone negotiated? The answer is almost always no. The only times they've rescinded offers is when the candidate was unreasonable, asking for 50% more than the initial offer, or revealed something problematic in the negotiation, became hostile, made threats, or showed poor judgment. Normal negotiation, asking for 10 to 20% more, discussing equity, talking about titles, that doesn't kill offers. It's expected. In fact, several recruiters told me they actually respect candidates who negotiate because it shows confidence and business savvy. So, here's the framework that actually works. Phase 1, the delay. When you get an offer, your first response should be enthusiastic but non-committal. Thank you so much for the offer. I'm really excited about the opportunity, and I think it could be a great fit. I'd like to take a day or two to review everything carefully and get back to you. When do you need a response by? This does 2 things. First, it signals that you're taking this seriously and you're a thoughtful decision maker. Second, it gives you time to prepare your negotiation without the pressure of responding in the moment. Never, ever accept an offer on the spot, even if it's amazing, even if you take it no matter what. Take at least 24 hours. This is a multi-year decision and potentially a $100,000 plus financial decision when you factor in compound effects. It deserves at least a day of consideration. Phase 2, the research. Now you've got 24 to 48 hours. Here's what you do. First, research comparable salaries using levels.fy for tech, Glassdoor, Payscale, and salary.com. Get specific for your exact role, your exact years of experience, and your location. Screenshot the data. Second, check if you have other options. Are you interviewing anywhere else? Do you have another offer?
even if the other offers are lower, they're still leverage points. If you don't have other offers, that's fine. You can still negotiate, but your approach will be slightly different. Third, calculate what you actually need and what you'd be thrilled with. Your need number is the minimum comp that makes sense given your current situation, your expenses, and your career trajectory. Your thrilled number is 15 to 20% above the offer. Your ask will be in between these. Fourth, and this is key, identify the non-cash components you could negotiate. These include signing bonus, equity, annual review timing, can you get reviewed at 6 months instead of 12, title, remote work flexibility, professional development budget, vacation days, start date, relocation assistance if applicable. Phase 4, the ask. Now you call or email the recruiter. Here's the structure. Start positive. Thanks again for the offer. I've had time to review everything and I'm really excited about the role. State your value. Based on my research and my experience with specific relevant accomplishment, I was expecting compensation in the X to Y range. Make a specific ask. Is there flexibility to move to specific number on base salary? I'd also be interested in discussing the equity allocation and the possibility of a signing bonus. Provide justification. I'm seeing similar roles at company type in location offering range for this experience level. Given my background in specific relevant skill or achievement, I think your ask is appropriate. Stay positive. I really want to make this work and I'm confident we can find something that works for both of us. Here's an actual email template that's worked for people I know. Hi, recruiter name. Thank you again for the offer to join company as role. I'm genuinely excited about the opportunity to work with the team and contribute to specific project or goal we discussed. I've given the offer careful consideration, and I wanted to discuss the compensation package. Based on my research of similar roles in location and my experience leading specific relevant achievement, I was expecting total compensation in the X to Y range. Is there flexibility to adjust the base salary to specific number? I'd also love to discuss the equity allocation and the possibility of a signing bonus. I'm confident we can find a structure that works for both of us. I'm happy to hop on a call to discuss further if that's helpful. Thanks for your time and consideration. Best, your name. Notice what this does. It's positive and collaborative. It's specific, actual numbers, not can you do better. It provides justification based on market data, not personal needs. It shows flexibility, multiple components to discuss, and it keeps the door open for conversation. Phase 4, the back and forth. They'll probably come back with something in the middle. Maybe they bump the base by $5K and add a $10K signing bonus. This is where most people say yes immediately because they're excited they got something. Don't do that. Come back with, I really appreciate you working with me. The revised offer is much closer. To get to a place where I can accept with full confidence, could we, one more specific ask?
That one more ask might be another $5K in base, an earlier review date, an extra week of vacation, a bigger signing bonus, or more equity. You're not being greedy. You're demonstrating that you know your worth and you're good at negotiation, which is literally a valuable skill in any job. Phase 5, the close. Once you've gotten a revised offer that's in your target range, accept enthusiastically. This works for me. I'm excited to join the team and make an impact. When can we finalize the paperwork? Get everything in writing. Review the offer letter carefully before signing. Make sure all the negotiated terms are included. Now, let me address the elephant in the room. What if they can't move on salary? This happens, especially at larger companies with strict comp bans or at smaller companies with tight budgets. Here's what you do. I understand the constraints on base salary. Can we explore other components of the package? I'd be interested in discussing 2 to 3 of these: signing bonus, equity, annual review timing, professional development budget, additional vacation days, or title adjustment. Signing bonuses are often the easiest thing for companies to approve because they're one-time costs, not recurring. I've seen companies that couldn't increase base salary by $10K add a $20K signing bonus without blinking. Equity is also often flexible, especially at startups or growth companies. If they can't move on cash, ask for 20 to 30% more equity.
Earlier review timing is underrated. If you can get reviewed at 6 months instead of 12 months, you're potentially getting a raise 6 months earlier. That compounds over time. Here's a real example. Someone I know was offered 110K base at a tech company in 2023. She wanted 125K. They said they could only go to 115K. She negotiated a 12K signing bonus, 30% more equity, and a 6-month review instead of 12-month. Total package in year 1, 127K base, plus signing bonus, plus equity value. Plus, she got that earlier review and ended up with a promotion to 135K at month 8 instead of waiting 12 plus months. The negotiation was worth about 35K in that first 18 months. One more thing about negotiation that I don't see people talk about enough. Your leverage is highest before you start. Once you've accepted an offer and started working, your leverage drops significantly, so use all your leverage up front. And here's something that's going to sound manipulative, but it's just strategic. If you have another offer or are in final rounds elsewhere, you can use that as leverage. I want to be upfront with you. I'm also in the final stages with other company and expecting an offer this week. I'm genuinely more excited about your opportunity because of specific reasons, but I need to make a decision that makes sense financially. Is there any flexibility on the compensation to help me make this an easy yes? This works because it creates urgency and competition. Just don't lie about having other offers. That can backfire badly. Okay, so you might be wondering, what about negotiating a raise at your current company? That's different and honestly harder. Most companies have rigid annual raise budgets, typically 3 to 5% for most employees. To get a meaningful raise internally, you usually need to get promoted, which requires building the case over months. Here's the internal raise playbook. 3 to 6 months before your review, start documenting your impact in business terms. Create a brag document where you log every accomplishment with quantified impact. 2 months before, set up a meeting with your manager. Say, I'd like to discuss my career trajectory and what it would take to move to the next level. What are the specific criteria and what would I need to demonstrate? Your review time? Come prepared with your brag document showing how you've exceeded expectations. Frame your ask as, based on my research of market rates for role in location, and given my contributions over the past year, I'd like to discuss adjusting my compensation to specific number or percentage. But here's the harsh truth. The biggest raises come from switching companies, not internal negotiations. The data is clear on this. If you want to jump from 60K to 100K plus, you're probably going to need to move companies at least once, maybe twice. There's one scenario where internal negotiation really works though, when you have a competing offer. If you get an external offer and you actually want to stay at your current company, you can sometimes leverage that offer into a counteroffer. But be careful. Some companies will counteroffer, you'll stay, and then they'll replace you within 12 months because they know you were looking. So only use this tactic if you're genuinely willing to leave if they don't match. All right, so now you understand how to negotiate better. But here's the thing. Negotiation only gets you so much. The real comp growth comes from strategic career moves and understanding the market dynamics. Let's talk about that next. But before we go there, let me hit you with something I bet you're thinking about. What if I'm just not in a position to negotiate? What if I need this job and I can't risk the offer? Look, I get it. If you're unemployed and running out of savings, or if you're in a toxic situation and need to escape, you might not feel like you can negotiate. That's a real situation, and I'm not going to judge you for taking an offer as is. But even in that situation, you can still ask. The way to do it safely is to ask curious questions rather than making demands. I'm really excited about this offer. Out of curiosity, is there any flexibility on specific component? If they say no, you smile and say, no problem, I understand. I'm still very excited to move forward. That approach has almost zero risk because you're not being aggressive, you're just asking. And you'd be surprised how often even that gentle ask results in something extra. Remember what I said at the beginning, by the time they give you an offer, they want you. They're not looking for reasons to rescind it. They're looking for reasons to get you to say yes. Strategy. Chapter 4. The Hidden Compensation Accelerators. What changes at 100K that nobody tells you?
Okay, we're about 45 minutes in. If you're still watching, you're serious about this, and that puts you ahead of 90% of people. Most people want financial success, but they're not willing to invest 2 hours to actually learn how to achieve it. So, let's talk about something fascinating that I didn't understand until I crossed 100K in comp myself. The rules change at different levels. There are threshold effects that unlock different opportunities and compound your earning potential.
Here's what I mean. When you're at 60K, your financial options are limited. You're probably dealing with student loans, you might be renting, you're living paycheck to paycheck or close to it, and saving is hard. Your primary focus is just increasing your income so you can breathe a little. But something interesting happens around 80K to 100K for most people. You start having surplus cash. Not a lot, but enough that you can start making strategic financial decisions that actually compound. And here's where it gets really interesting. Once you hit 100K plus in comp, you unlock access to compensation structures that weren't even available to you before. Let me explain what I'm talking about. The first hidden accelerator? Tax-advantaged compensation. At lower income levels, you can't really take advantage of tax optimization because you don't have enough surplus to max out retirement accounts or use other tax strategies. But once you're at 100K plus, this becomes a game changer. Here's the math. If you're making 60K, you're probably in the 22% federal tax bracket. Every dollar you earn costs you about 22 cents in federal tax, plus state tax, plus FICA. So you're keeping maybe 65, 70 cents on the dollar. But if you contribute to a 401k, that money comes out pre-tax. So you're effectively saving 30 to 35% on those contributions. Now at 60K, maxing out your 401k, $22,500 in 2023, $23,000 in 2024, is basically impossible unless you have no other expenses. But at 100K, it's tight but doable. At 150K, it's comfortable. Here's what this looks like in practice. Someone making 150K who maxes their 401k is saving about $7,650 in federal taxes annually compared to not contributing. That's money you can redirect to other investments. Over 20 years at a 7% return, that tax savings alone compounds to about $333,000. But wait, there's more. Once you're at higher comp levels, companies often offer additional tax-advantaged options. HSAs, health savings accounts, mega backdoor Roth conversions, ESPPs, employee stock purchase plans, deferred compensation plans. Let me break down HSAs because they're insanely underrated. An HSA is technically for healthcare expenses, but here's the hack. If you can afford to pay your medical expenses out of pocket, you can invest your HSA contributions and let them grow tax-free. You contribute pre-tax money, it grows tax-free, and withdrawals from medical expenses are tax-free. It's literally the only triple tax-advantaged account in existence. The 2024 contribution limit is $4,150 for individuals, $8,320 for families. If you max this out every year from age 30 to 65 and get a 7% return, that's about $733,000 tax-free by retirement. And here's the kicker. After age 65, you can withdraw for any reason and just pay ordinary income tax, making it basically another retirement account. But you need to have a high-deductible health plan to qualify for an HSA, and you need surplus income to pay medical expenses out of pocket while your HSA grows. This is way easier at 100K plus than at 60K plus. The second hidden accelerator is equity and ownership. This is huge. At 60K, most jobs don't offer meaningful equity. You might get a tiny 401k match, but that's about it. But as you move up to 100K to 200K total comp, equity becomes a standard part of the package, especially in tech, finance, and high-growth companies. And this is where wealth actually gets built. Your salary pays your bills, your equity builds your net worth. Let me give you some real numbers. I have a friend who joined a late-stage startup in 2019 as a senior manager making 130K base plus 30K bonus and equity worth about 50K per year at the time of grant. Total comp, 210K. The equity was 20,000 stock options at a $15 strike price. Fast forward to 2021, company goes public. Stock price at IPO, $45 per share. His 20,000 options are now worth $600,000. 45 minus 15 is $30 profit per share times 20,000 shares, netting about $200,000 after everything. That's an entire year's salary as a bonus from just 2 years of equity vesting. And this wasn't even a huge success story. The company IPO'd but didn't 10x or anything crazy. Now, obviously, equity is risky. Most startups fail. But here's the strategic way to think about it. Once you're at $100K plus base salary, you can afford to take equity risk because your base covers your expenses, so you can target roles that offer meaningful equity upside. For example, if you're choosing between Company A, 140K base, 20K bonus, no equity, equals 160K total comp, versus Company B, 120K base, 20K bonus, and equity worth 40K per year is 180K total comp. Company B might be the better choice if you believe in the company's growth potential, because that equity could be worth way more than 40K per year if things go well. Or it could be nothing, but your 120K base still covers your life, so you can take that bet. This is the mindset shift that happens at higher comp levels. You start thinking in terms of expected value and portfolio approach rather than just guaranteed income. The third hidden accelerator is network and access. Here's something subtle but powerful. As your comp increases, your network changes. You start working with more senior people, you get invited to different events, you have access to different opportunities. At 60K, you're probably working with other individual contributors making 50K to 80K. Nothing wrong with that, but the opportunities flowing through that network are limited. At 150K plus, you're working with directors, VPs, maybe C-suite folks. You're at companies that recruit more aggressively. Recruiters reach out to you more often because you're at a certain level. You're in rooms where bigger decisions get made. This compounds over time. The opportunities available to someone with a strong network at the 150K plus level are just fundamentally different than opportunities available at the 60K level. I saw this firsthand when I moved from a smaller company where I was making 78K to a larger tech company where my comp jumped to 135K. Within 6 months, I had 3 recruiters reach out for roles paying 150K to 200K at annual comp. At my previous company, I never got those messages. The LinkedIn algorithm literally surfaces you differently based on your company and title. The fourth hidden accelerator is negotiation leverage compounds. Here's one wild. The more you make, the easier it is to negotiate for even more, because your previous comp becomes the floor for your next role.
When you're at 60K and you're interviewing for a new role and they ask about your current comp, some states ban this question, but many don't. You say 60K and they offer you 70K and you feel like you won. But the person coming from 120K gets offered 140K for the same role because companies anchor to your previous comp. I know this feels unfair, and it kind of is, but it's how the system works. And once you understand it, you can use it to your advantage. This is why your first big jump is so important. If you can get from 60K to 90K in one move, your next move will start negotiations at 90K as the baseline. Within 2 more moves, you're at 120K to 140K. Then your next move gets you to 170K plus. Each jump builds on the previous one. The fifth hidden accelerator, skills investment. When you're at 60K, paying $2,000 for a professional course or certification feels impossible. But at 120K plus, that's a reasonable investment if it helps you get to 150K or land your next role. I spent $3,500 on a data analytics certification program in 2022. At the time, I was making about 125K. That certification was part of what helped me land my next role at 170K total comp. Return on investment, 45K per year ongoing. That's 1,186% ROI in year 1 alone. But I could only make that investment because I had the surplus income to afford it without going into debt.
This is another way that money makes money. You can invest in yourself more aggressively when you have the resources. The same applies to things like hiring a career coach, $200 to $500 per session, getting your resume professionally written, $500 to $1,000, attending industry conferences, $1,000 to $3,000, or taking time off between jobs to skill up instead of jumping immediately to the next paycheck. The sixth hidden accelerator, geographic arbitrage. This one's newer, but it's become massive since 2020. Once you're making $100K, especially in knowledge work, you have access to remote roles that pay based on high cost of living areas, even if you live in a lower cost area. Think about it. Someone living in San Francisco making $150K has roughly the same quality of life as someone living in Austin making $100K due to cost differences. But what if you get the San Francisco company to let you work remotely from Austin while keeping most of your SF-based salary? I know multiple people who did this during the pandemic. They were making $130K to $160K in places like NYC or SF, went remote, moved to cities like Denver, Nashville, or Raleigh, and either kept their comp or took a small cut, but came out way ahead because their costs dropped by 30 to 40%. This strategy works best when you're already at a comp level where location matters less than skills and experience. At $60K, most jobs are local, and you can't really negotiate remote work. At $120K plus, especially in tech, remote is often standard. Here's a specific example. Someone I know was making $145K in Seattle working for Amazon, went remote during COVID, moved to Boise. Amazon did adjust her salary down to $125K for the new location, but her rent went from $2,400 for a one-bedroom to $1,300 for a two-bedroom house. Her effective spending power went up despite the pay cut. Now let me tell you about something that ties all of this together, and this is part of what I've been teasing throughout this video. The meta accelerator, comp visibility, and market awareness. Once you're at $100K plus, you become obsessed with understanding compensation structures. You check levels.fyi regularly. You talk to peers about what they make. You track market trends. You understand equity packages. You know which companies pay well and which don't. This market awareness itself becomes an accelerator because you make better career decisions. You don't waste time on roles that aren't worth your time. You target companies with strong comp structures. You negotiate better because you have better data. Most people at $60K don't even know about levels.fyi or how to properly evaluate equity packages. They're just happy to get a job offer. But people at $150K plus are sophisticated about compensation. They compare offer letters like investors compare term sheets. This knowledge compounds over your career because each decision builds on better information. Okay, so here's the thing I want you to really internalize from this section. Getting to $100K is hard. It requires building skills, negotiating well, probably switching companies. But once you're there, getting to $200K is actually easier in some ways because these hidden accelerators kick in. It's like compound interest for your career. The first $40K is the hardest. The next $40K is a bit easier. The $40K after that, you have momentum. Now we're halfway through this video. If you're getting value out of this, do me a favor, hit the like button. It genuinely helps the algorithm show this to more people who need it. And if you haven't subscribed yet, subscribe because we're putting out deep dive content like this regularly. All right, let's talk about something tactical, how to actually structure your career moves to maximize comp growth.
The key is being intentional about which skills you're requiring and making sure they're high value in the market. Don't take a skill acquisition role to learn something that's being commoditized. Take it to learn something that's in high demand and will be for at least 3 to 5 years. Move type 2, the brand name move. This is when you take a role at a prestigious company primarily for the resume value, even if the comp or actual work isn't optimal. You're buying credibility. The brand name companies in every industry, FANG for tech, Goldman, McKinsey, BCG for finance and consulting, Procter & Gamble for consumer goods, Mayo Clinic for healthcare. These names on your resume open doors forever. I know someone who took a role at Google making $140K when they had an offer from a startup for $175K. They chose Google specifically for the brand. After 2 years at Google, they left for another startup where they negotiated $220K because the Google credibility gave them negotiating power. The calculation was, take 35K less per year for 2 years, 70K total, gain brand credibility, then make 80K more per year going forward. That's a positive ROI within the first year after leaving. Now, the brand name move doesn't work if you're going to be miserable or if it's going to stall your skills development. But if you can get into a brand name company and actually learn while you're there, that's powerful. Move type 3, the promotion path move. This is when you join a company specifically because you can see a clear path to promotion within 12 to 18 months, and that promotion will come with a significant comp increase. Fast-growing companies, companies that just raised funding, companies entering new markets, these often have promotion opportunities that are more predictable and faster than mature companies. Here's how you identify this. During the interview process, ask about team growth plans. Where do you see this team in 18 months? Are you planning to hire more people? What does career progression typically look like? If they say, we're planning to double the team in the next year, that's a signal, because someone needs to manage those new people. If you come in as a senior IC and crush it for 12 months while they're hiring 5 to 10 more people, you're the obvious candidate to become the manager or lead. And that promotion often comes with a 20 to 30% comp bump. So you might join at 95K, get promoted to 125K after 15 months, then leverage that title and comp to get 155K at your next company after another 18 months. I've seen this play out dozens of times. The key is targeting the right kind of company. Not too early stage, they might not have the funding to actually grow. Not too mature, promotion paths are slow and political. Next up, move type 4, the comp maximization move. This is the straightforward move where you're targeting the highest possible comp for your current skill level. You're not trying to learn new skills or gain credibility, you're trying to cash in on what you've already built. This move makes sense when you've built strong skills, you've got some brand names on your resume, and you want to maximize comp for 2 to 3 years before your next strategic move. This is when you target roles at companies known for paying top of market, certain hedge funds, high-frequency trading firms, big tech companies, well-funded startups in hot markets. For example, if you're a software engineer with 5 years of experience and you've got Google on your resume, you could probably get 200K to 250K at a hedge fund, even though the work might not be as interesting as a startup. But maybe you want to maximize comp for a few years to pay off student loans or save for a house. This move makes sense. Next up, move type 5, the equity upside move. This is when you join an earlier stage company primarily for the equity potential, accepting lower base comp because the expected value of the equity is high. This is risky, but it can be life-changing. The people I know who've built serious wealth, $1 million plus, from their careers, mostly did it through equity at high-growth companies. The key is doing this strategically. Only take equity upside moves when your finances can handle the base salary being lower and when you actually believe in the company's potential. Don't just chase equity at any startup. And diversify your career risk. Don't take multiple equity upside moves in a row unless you hit one. If your first startup doesn't work out, your next move should probably be a comp maximization or brand name move to stabilize. Here's a real example of stringing these moves together strategically. Years 1 to 2, work at a mid-sized company making 62K, learning fundamental skills. Skill acquisition. Years 3 to 4, join a well-known company making 85K, get brand on your resume. Brand name. Year 5, get promoted to senior role at the same company, comp goes to 105K. Promotion path. Years 6 to 7, leave for a scaling startup as a manager, comp is 130K base plus 40K equity value equals 170K total comp. Year 8, startup does well, equity is now worth 80K per year, effective comp is 210K. Year 9, cash out equity, leave for a corp role at an established company making 190K base plus 30K bonus, comp maximization. That's going from 62K to 220K in 9 years through strategic moves, each building on the previous one. The average annual raise is about 15 to 18%, which is ambitious but doable with intentional planning. Now, here's the crucial part most people miss. You need to think about sequencing. The order of these moves matters. Generally, the best sequence is skill acquisition early when you can afford lower comp, brand name once you have core skills, promotion path to get title bump,
equity upside when you have financial stability, and comp maximization when you want to cash in. But everyone's situation is different. If you're 35 with kids and a mortgage, you probably can't do a low-comp skill acquisition move. You need to go straight to comp maximization. If you're 25 and living with roommates, you have more flexibility to optimize for learning and brand. The key is being intentional. Ask yourself, what's my primary goal with this next move? Am I optimizing for skills, brand, promotion path, equity, or pure comp? And does this move set me up for a strong move after it? Here's something I wish someone had told me earlier. The best time to plan your career is when you're employed and comfortable. When you're desperate or unemployed, you're in reactive mode. But when you're doing well in your current role, you can be strategic about what comes next.
So even if you're happy right now, spend time every quarter thinking about, where do I want to be in 3 years? What skills do I need to get there? What companies would value what I have? What's the market paying for my skills? This proactive approach is the difference between earning $120K at age 35 and earning $200K at age 35. Let me share something personal. When I was making about $70K, I got offered a role at $88K at a stable company and a role at $78K at a fast-growing startup. I almost took the $88K because the money was significantly better. But I talked to a mentor who asked me, which role sets you up better for your next move? That question changed my entire thinking. I took the $78K startup role. The company grew fast, I got promoted after 14 months, my comp went to $115K, and then I leveraged that experience to land a role at a larger company for $145K. If I'd taken the $88K stable role, I'd probably still be there making $102K after raises. The $10K short-term sacrifice turned into a $40K plus annual gain within 3 years. Okay, so now you're probably wondering, how do you actually find these strategic opportunities? How do you know which companies are growing, which ones pay well, which ones will promote you? Great question. Let me give you the research framework. For identifying fast-growing companies, check Crunchbase for recent funding rounds, read Built-in for company spotlights, follow industry news for market trends, look at LinkedIn for companies showing rapid employee growth. For identifying high-paying companies, Levels.fy for tech, Glassdoor for other industries, talk to recruiters, check company rating sites like Comparably. For identifying companies with good promotion paths, look at employee reviews on Glassdoor specifically mentioning career growth, check LinkedIn to see how long people stay before getting promoted, ask during interviews about team growth plans. For identifying companies with valuable equity, research the company's funding history, market position, growth trajectory. Talk to current employees, if possible, about how they value the equity. Do this research before you even start applying. Create a target list of 20 to 30 companies that align with your strategic goals, then focus your job search on those companies rather than just applying randomly. This targeted approach is way more effective than spray and pray job applications. I've seen people send out 200 applications and get nothing versus people who carefully apply to 15 companies and get 5 interviews. All right, next section. Let's talk about the specific tactics that accelerate your timeline from 60K to 200K. Chapter 6, the timeline compression tactics, how to do in 4 years what takes most people 10. We're about 75 minutes in. You're still here. That tells me you're actually serious about this. And honestly, that puts you in probably the top 5% of people watching finance content. Most people want quick tips. You're going deep. Respect. So let's talk about timeline compression, because here's the truth. The strategies I've shared so far work, but they typically take 5 to 8 years to get you from 60K to 200K. What if you want to do it faster? It's possible, but it requires you to be more aggressive and more strategic. Here are the tactics that compress the timeline. Tactic 1, the double skill strategy. Most people build one skill deeply, but if you can build 2 complementary skills that are both valuable, you become rare and can command much higher comp. For example, software engineering plus machine learning, marketing plus data analytics, sales plus technical expertise in a specific domain, finance plus operations,
product management plus design. The key is that the combination is rare even if each individual skill isn't. There are lots of software engineers. There are lots of people who know some ML, but software engineers who can actually build and deploy ML models in production, that's a smaller pool, and they command $180K to $250K at most tech companies. Here's how you execute this. Identify 2 skills that complement each other and that you're interested in. Spend 18 to 24 months getting competent at both. Then target roles that specifically need that combination. I did a version of this. I was decent at marketing, but so are lots of people. I spent about a year getting really good at data analysis, SQL, Python, statistics, experimentation. Now I'm a data-driven marketer who can run the marketing team and build the analytics infrastructure. That combination has been worth probably $50K in additional comp because it's less common. Tactic 2, the industry jump. Some industries pay way more than others for similar work. If you can take your skills from a low-paying industry to a high-paying industry, you can 30 to 50% comp increase in one move. Generally speaking, tech, finance, and consulting pay the most. Healthcare, education, nonprofit, and government pay the least. Retail, hospitality, and manufacturing are in the middle. So if you're a project manager in healthcare making $65K, you could potentially move to a project manager in tech making $95K to $110K doing similar work. The challenge is that industry jumps are harder to execute because companies often want industry experience. But here's the workaround. Find transitional roles at companies that bridge both industries or target companies in your target industry that are specifically hiring people from other backgrounds. For example, healthcare tech companies often hire people from healthcare because they need that domain knowledge. Financial tech companies hire from finance. That's your bridge. Tactic 3, the startup lottery done smartly. I mentioned equity upside earlier, but let me be more specific about how to do this in a way that compresses your timeline. Join a startup that's Series B or later, they've proven some traction, in a massive market, TAM of $10 billion plus, with experienced founders, not first-time founders, with strong investors, top-tier VCs, and you can see a path to IPO or acquisition within 3 to 5 years. If you check all those boxes, the equity has a reasonable chance of being worth something life-changing. Not guaranteed, obviously, but even after everything, if you end up with $1 million to $2 million from a 4-year stint at a startup, that's life-changing wealth.
The key is being selective. Don't join any startup with equity. Join one with a real shot at a big outcome. Tactic 4, the consulting to corporate move. This is a well-known but underused strategy. Spend 2 to 3 years at a top consulting firm, McKinsey, Bain, BCG, Deloitte, etc., or investment bank. Work brutal hours, but learn a ton and get the brand name, then exit to a corporate role at a much higher comp than you could have gotten directly. People who spend 3 years at McKinsey routinely exit to corporate strategy roles paying $150,000 to $200,000 even though they're only 3 years into their career. That's because the McKinsey brand signals that you're smart, you work hard, and you know how businesses work. The downside is those 3 years are rough, 60 to 80-hour weeks, lots of travel, high stress. But if you can handle it, it's a massive accelerator for your career. Tactic 5, the certification hack. For certain fields, getting a specific certification can immediately increase your market value by $20,000 to $40,000. Things like CFA, Chartered Financial Analyst for finance, PMP, Project Management Professional for project managers, AWS Solutions Architect or other cloud certs for tech, CPA, Certified Public Accountant for accounting. These certifications are hard to get, which is why they're valuable, but if you can dedicate 6 to 12 months to studying and pass them, you immediately become more marketable. A friend of mine got his CFA while working full-time. It took him 2.5 years. You have to pass 3 levels. When he passed all 3 levels, he switched jobs and his comp went from $85K to $135K specifically because of the CFA designation. That's $50,000 per year ongoing for about 900 hours of studying. That's $55 per hour of studying in perpetuity. Good ROI. Tactic 6, the geographic jump.
We talked about geographic arbitrage, but here's a more aggressive version. Move to a high comp city, work there for 2 to 3 years to maximize your comp and get it locked in at that level, then move to a lower cost city while negotiating remote work. For example, you're in a mid-tier city making 70K. You move to San Francisco or New York and get a role for 110K. Yeah, your costs go up, but your comp is now at that level. After 2 years, you find a remote role that pays 105K and you move back to your mid-tier city or a different lower-cost city. Now you're making 105K while living somewhere cheap. This requires being willing to be uncomfortable for a couple years in an expensive city, but it can permanently up-level your comp. Tactic 7, the build in public strategy. This is newer and not for everyone, but it works. Build a public presence in your field through writing, speaking, or creating content. Become known for expertise in a specific area. Then leverage that reputation into higher paying opportunities. People who are known in their industry can command 20 to 40% premiums because they bring credibility and potentially customers, users, or attention to the company. For example, if you're a designer who has 20K followers on Twitter and writes about design trends, companies will pay you more because hiring you also gets them visibility and credibility in the design community. This tactic takes time to build, usually 18 to 36 months of consistent content creation. But once you have that presence, it compounds forever. Tactic 8, the multiple offers strategy. This one's simple but powerful. Never accept a job offer without having at least one other option, and preferably 2 to 3 offers. Interview at multiple companies simultaneously. When you get offers, use them to negotiate with each other. I have another offer for X dollars, but I prefer your company. Can you match or beat that? This requires discipline to not accept the first offer you get, but it consistently results in 10 to 20% higher comp than accepting the first offer. Here's how to execute this. When you decide to look for a new role, apply to 15 to 20 companies within a 2-week window. Schedule all the interviews within a similar time frame. Try to get offers around the same time, then negotiate. I know someone who did this perfectly. Applied to 18 companies, got 6 first-round interviews, 4 second rounds, 3 offers. Used the offers to negotiate. Started with offers of 95K, 102K, and 110K. Ended up accepting one at 125K after negotiation. That's $15,000 more than the highest initial offer just through competition. Tactic 9, the side income acceleration. While you're building your career comp, also build side income. This serves 2 purposes. It provides additional income now, and it can become a negotiation tool later, saying, I'm currently making X dollars in salary plus Y dollars from consulting or freelancing, so my total income is Z dollars. Also, side income can sometimes become your main income if it scales, but even if it doesn't, having an extra $10,000 to $30,000 per year from side work compounds your ability to invest and build wealth. The key is finding side work that doesn't completely burn you out. Freelancing, consulting, teaching, creating digital products, find something that uses your existing skills so you're not starting from scratch. Tactic 10, the selective patience strategy. Okay, this one sounds contradictory to compression tactics, but hear me out. Sometimes the fastest path is to be patient in the right role while saying no to lateral moves. If you're at a good company with strong growth trajectory and you're getting promoted regularly every 12 to 18 months, staying there for 3 to 4 years can get you to $200,000 faster than jumping around. The mistake people make is either staying too long at a dead-end company or leaving too quickly from a great company where they're on a promotion path. The framework, if you're getting promoted and getting 15+% comp increases annually, stay. If you're stuck with 3% raises and no promotion path, leave. Now, here's the thing about all these tactics. You can't do all of them simultaneously. You have to choose 2 or 3 that fit your situation and execute them well. For example, you might combine the double skill strategy plus the multiple offer strategy plus the startup lottery. Spend 18 months building complementary skills, then interview at 5 to 8 high-growth startups, get multiple offers, negotiate them against each other, and join the best one with meaningful equity. Or you might do the industry jump, the certification hack, and the geographic jump. Get a certification that's valuable in a higher-paying industry, move to a high-paying city, switch industries while leveraging your new certification.
The point is to be intentional and strategic about which tactics you employ and how they fit together. All right, let's talk about something most people completely overlook, but it's absolutely critical to hitting 200K plus. Chapter 7, the Comp Structure Mastery. Understanding RSUs, ISOs, NSOs, and everything they don't tell you about equity. So we've talked about equity several times, but I want to go deep on this because understanding equity compensation is the difference between leaving 50K to 100K on the table and actually capturing that value. Most people at 60K don't deal with equity, but as you move toward 100K to 200K plus, equity becomes a bigger and bigger portion of your comp. And if you don't understand how it works, you're going to make expensive mistakes. Let me break down the main types of equity compensation. RSUs, restricted stock units. This is the most straightforward type. The company grants you shares that vest over time, usually 4 years. When they vest, they're yours. They're treated as ordinary income and you pay taxes on them. For example, you get 1,000 RSUs worth $50 per share at grant, vesting over 4 years, 25% per year. After year 1, 250 shares vest. If the stock is now at $60, you get $15,000 worth of stock, and you owe taxes on that $15,000 as if it were salary. RSUs are common at public companies like Google, Meta, Apple, etc. They're the least risky form of equity because they have value as long as the stock has any value at all. Here's what most people don't understand about RSUs. They're taxed at vest, not at sale. So if your RSUs vest and the stock is worth $20,000, you owe taxes on $20,000 even if you don't sell. Many companies automatically sell some shares to cover taxes, but sometimes they don't sell enough and you end up owing. Pro tip, look at your vesting schedule and plan for the tax hit. Set aside money in the months leading up to a big vest. Stock options, ISOs and NSOs. These give you the right to buy stock at a specific price, the strike price, but you don't have to. There are 2 types. ISOs, incentive stock options, are for employees only and have tax advantages. When you exercise them, you don't owe regular income tax immediately. Instead, you might owe AMT, alternative minimum tax, and when you eventually sell the shares, you pay capital gains tax if you've held them long enough, 1 year after exercise, 2 years after grant. And NSOs, non-qualified stock options, don't have the same tax benefits. When you exercise, the difference between the strike price and current price is taxed as ordinary income immediately, potentially 35 to 40% with state taxes. That's a $30,000 to $50,000 difference in taxes. Here's the mistake people make with options. They don't understand that options require you to have cash to exercise them. If your strike price is $5 and the stock is worth $25, you need $50,000 cash to buy 10,000 shares. A lot of people don't have that cash sitting around. Also, if the company never goes public or gets acquired, your options might be worthless even if they're in the money on paper because you can't sell them. RSAs, restricted stock awards. These are less common, but they exist. You get actual stock up front, but it's restricted and vests over time. The advantage is you make an 83B election to pay taxes on the value at grant instead of at vest. If the stock appreciates significantly, this can save you a lot in taxes. This is mainly relevant at very early stage startups where the stock value is near zero at grant. Phantom stock and stock appreciation rights, SARs. Some private companies use these. You don't get actual stock, but you get cash payments tied to the stock's value appreciation. These are taxed as ordinary income when paid out. Now, here's what you really need to know about equity compensation. The 4-year vesting cliff. Most equity vests over 4 years with a 1-year cliff. This means you get nothing in the first year, then 25% vests at the 1-year mark, then the rest vests monthly or quarterly over the remaining 3 years. This structure is designed to retain employees. If you leave before 1 year, you get no equity. If you leave at 18 months, you only get 37.5% of your total grant. Here's the strategic implication. When you're evaluating offers, discount the equity value based on the likelihood you'll stay for the full 4 years. If you think you might leave after 2 years, only count 50% of the equity value in your total comp calculation. The refresh grant reality. Many people don't realize this. Equity grants don't automatically refresh. At most companies, you get an initial grant when you join. Then you might get a refresh grant at your annual review, but it's not guaranteed and it's often smaller than your initial grant.
So your compensation can actually decrease over time if your RSU value is high initially, but refresh grants are small or non-existent. For example, you join a company with a $200K offer, $140K base plus $60K per year in RSUs, 4-year grant worth $240,000 total. In year 1, you're making $200K, but in year 5, if you only got small refresh grants, maybe you're only getting $20K per year in RSUs vesting, so your effective comp is now $160K, even though your base might have increased to $150K. This is why people at big tech companies change jobs every 3 to 4 years to get new, large equity grants. And the tender offer opportunity. At private companies, your equity is illiquid. You can't sell it. But some late-stage startups do tender offers where investors buy shares from employees before an IPO. These are opportunities to get some cash out of your equity early. If your company does a tender offer, consider selling at least some shares, maybe 20 to 40% of what you're allowed to sell, to de-risk. Because if the company never goes public or the IPO flops, you'll be glad you took some money off the table.
I've seen people whose equity was worth $500K on IPO day, then $800K after 90 days, then $350K when the lockup expired. The emotional roller coaster is real. Strategy? Have a selling plan before the lockup expires. Decide what percentage you'll sell immediately to de-risk and diversify, and what percentage you'll hold. Don't make emotional decisions during the lockup period. The exercise window problem. When you leave a company that granted you stock options, you typically have 90 days to exercise them or they expire. This can be a nightmare if 1. You don't have the cash to exercise, 2. The company is still private so you can't sell to cover, 3. The exercise cost plus taxes is enormous. Example, you have options worth $150K on paper, but it costs $40K to exercise and another $30K in taxes. You need $70,000 in cash within 90 days of leaving just to capture that value. A lot of people can't do that, and they let valuable options expire. Some companies have extended this to 7 or 10 years, which is way better. Ask about exercise windows when evaluating offers. The Section 409A valuation game. For private companies, the strike price of your options is set based on a 409A valuation. Companies usually do these valuations every 12 months. Here's the inside knowledge. If you're joining a startup, try to join right after they've done a 409A valuation, not right before, because the valuation might be low now, which means low strike price for your options, which means more upside potential. Also, if a company is raising a new funding round, the 409A valuation will increase significantly after that round closes. So if you can get your offer letter before the new round closes, your strike price might be based on the old, lower valuation. This can be worth tens of thousands of dollars in additional equity value. The tax optimization strategy. For ISOs, there's an advanced strategy. Exercise your options early when the strike price and current price are close, hold the shares for at least 1 year after exercise and 2 years after grant, then sell and pay long-term capital gains tax instead of ordinary income tax. This requires cash upfront and conviction that the company will do well, but the tax savings can be massive. Example, you have 10,000 ISOs with a $10 strike price. Stock is currently at $12. You exercise for $100,000 when the stock is $12. You hold the shares. 2 years later, the company IPOs at $50 per share. You sell for $500,000. Your gain is $400,000 taxed at capital gains rates, 20%, instead of ordinary income, 37+%. That's a $68,000 plus tax savings. Okay, so why am I going so deep on equity? Because understanding this stuff is what separates people who actually accumulate wealth from people who just have high incomes. Your salary pays your lifestyle. Your equity builds your net worth. If you're making $200,000 in total comp with $150,000 salary and $50,000 in equity, and you spend most of that $150,000 salary, you're still building wealth through that equity.
But if you don't understand how to evaluate equity offers, how to exercise options strategically, how to diversify after vesting, and how to minimize taxes, you're leaving serious money on the table. Here's my framework for thinking about equity. At $60,000 to $100,000, equity is nice but not essential. Focus on maximizing cash comp and building skills. At $150,000 to $200,000 plus, equity should be 25 to 40% of your total comp. You're building wealth now, not just earning income. And remember what I said earlier about that big strategy I'm saving for the end? Understanding equity is actually part of that, because that strategy involves a specific way of leveraging equity compensation that most people never think about. We're getting close to that, but first, let me talk about something that's going to determine whether you can actually sustain $200,000 comp over the long term. All right, we're about 100 minutes in. We've covered a lot: skills, negotiation, career moves, equity, but here's something nobody talks about. Hitting 200K is one thing, sustaining it is another. I've seen people get to $150,000 to $200,000 comp and then flame out within 2 to 3 years because they couldn't handle the pressure, the hours, the politics, or the performance expectations. And then they end up back at $100,000 to $120,000 in a less demanding role. This is a real thing. Not everyone wants to or can sustain high comp roles, and that's okay. There's no judgment here, but you need to know what you're getting into. Here's what changes at higher comp levels. Expectation inflation. At $60K to $100K, expectations are usually reasonable. Do your job, meet your metrics, don't screw up too badly. At $200K, expectations are high. You're expected to be in the top 20% of performers. You're expected to work on high-impact projects. You're expected to handle ambiguity and complexity. If you're at a tech company making $200K and you're just meeting expectations, you're probably not getting promoted and your refresh grants will be small. You need to be exceeding expectations consistently. This means longer hours, more stress, higher stakes, less room for error. Political complexity. At lower levels, you can often just put your head down and do good work. At higher levels, organizational politics matter more. You need to manage stakeholders, navigate competing priorities, influence without authority, build alliances. Some people are great at this. Others hate it and find it draining. If you're in the latter camp, high comp roles might not be sustainable long-term for you. Constant skill updating. At $60K to $80K, you can often do the same type of work for years. At $150K plus, you need to constantly evolve your skills because the market changes fast and companies expect senior people to stay current. This means you're spending personal time learning new tools, reading industry news, taking courses, attending conferences. It's part of the job. The golden handcuffs. Here's something weird that happens. The more you make, the harder it is to leave, because taking a pay cut feels terrible, even if it would improve your quality of life. I know people making $250,000 who are miserable but won't leave because they can't imagine going back to $150,000, even though $150,000 would still be a great lifestyle, and they might be much happier. This is a real psychological trap. Your lifestyle inflates to match your income, and then you feel stuck.
The way to avoid this? Keep your core expenses below 60% of your income, even as you earn more. Save and invest the difference. That way, you maintain flexibility. If you're making $200K but spending $180K, you're trapped. If you're making $200K but spending $100K and investing $70K, you have options. The health tax. High-paying jobs often come with stress that affects your health. Sleep deprivation, poor diet, lack of exercise, chronic stress. These things compound over years. I'm not trying to scare you, I'm trying to be real. If you're going to go for $200K plus, you need to actively protect your health. That means regular exercise, decent sleep, therapy if you need it, boundaries around work, and being willing to switch roles if the health tax becomes too high. Some people can handle high-stress roles for decades. Others burn out after 3 to 5 years. Know yourself. The relationship strain.
Long hours and work stress can strain relationships. If you're married or have a partner, have honest conversations about what you're signing up for. If you have kids, think about how much time you'll actually have with them. Again, I'm not saying don't go for high comp. I'm saying go in with eyes open and make conscious choices about trade-offs. Now, here's the good news. Not all 200K roles are soul-crushing. Some companies have great cultures, reasonable hours, and a sustainable pace. The key is being selective about where you work, not just how much they pay you. When you're evaluating offers, don't just look at comp. Look at what are typical working hours, what's the on-call expectation, what's the meeting culture like, how often do people get promoted, what's the turnover rate, what do employee reviews say about work-life balance. A $200,000 job at a company with 55-hour weeks and a healthy culture is way better than a $220,000 job at a company with 70-hour weeks and a toxic environment. You can find this information by reading Glassdoor reviews, talking to current employees on LinkedIn, asking directly in interviews, and trusting your gut during the interview process. Here's my personal philosophy. I want to maximize lifetime earnings and wealth, not single-year earnings. That means optimizing for sustainability. I'd rather make $200K for 20 years, $4 million total, than $300K for 3 years and then burn out and drop to $100K for the next 17 years, $3.6 million total. Long-term thinking wins. The skill plateau risk. Here's something subtle. At very high comp roles, sometimes you stop building transferable skills because you're so specialized, or you're in so many meetings, or you're managing rather than doing. If you're not careful, you can end up making $200K, but not actually building skills that would help you get another $200K role if you lost this one. You're valuable to this company, but not to the broader market. Guard against this by continuing to do some hands-on work even as you advance, learning new skills on the side, staying connected to your industry, and keeping your resume updated with recent accomplishments. The imposter syndrome factor. A lot of people at high comp levels deal with imposter syndrome, the feeling that they don't deserve to be there or they're going to be found out. This is super common, especially for people who came from lower income backgrounds. You're making more than your parents ever made, more than most of your friends, and part of you feels like you're faking it. The thing is, you're not. If you're being paid $200K, it's because you're providing that much value to the company, or more. Companies don't pay $200K out of charity. They do it because the market demands it and because you're delivering results. But imposter syndrome can be draining and can lead to overwork trying to prove you belong. The solution is therapy, supportive community, and reminding yourself that you earned this. Okay, so how do you actually sustain high comp over the long term? Strategy 1. Build a financial cushion. Save aggressively for the first 3 to 5 years of high earnings. Build a 12-month emergency fund. Pay off high-interest debt. This gives you freedom to leave if you need to. Strategy 2. Invest in your health. Seriously. Exercise, sleep, mental health. These aren't optional. They're what allow you to sustain high performance over decades. Strategy 3. Set boundaries. Even in demanding roles, you can set some boundaries. Maybe you don't work weekends. Maybe you don't check email after 8 p.m. Figure out what your non-negotiables are and protect them. Strategy 4. Build transferable skills. Always be learning things that would be valuable at other companies. Don't let yourself become so specialized that you're only valuable to one employer. Strategy 5. Maintain relationships outside work. Your worth isn't just your job. Invest in friendships, family, hobbies. These things keep you grounded and they're your support system if work gets tough. Strategy 6. Have an exit plan. Know what you'd do if you needed to leave. Have recruiters in your network. Keep your LinkedIn updated. This isn't about actively looking to leave. It's about knowing you have options. All right, one more major section before I reveal that big strategy I've been teasing. Let's talk about the financial management piece that most people get wrong. the wealth building engine, what to actually do with your money once you're making it. So you've gone from 60K to 150K to 200K. Congratulations. But here's the thing most people don't realize. Your income is a wealth generation engine only if you actually convert that income into wealth. I know too many people making 150K to 200K who have net worths under 100K because they spend everything they make. Meanwhile, I know people making 100K who have net worths over 500K because they're disciplined about saving and investing. Your goal isn't just to make 200K. Your goal is to convert that 200K into financial independence, optionality, and generational wealth. Here's the framework. The 50-30-20 rule modified for higher earners. The traditional rule is 50% needs, 30% wants, 20% savings. But when you're making 200K, you can and should adjust this to something like 40% needs, 20% wants, and 40% savings.
Let me break this down with actual numbers. At 200K gross income, after taxes, roughly 30% to 35% depending on state, 130K to 140K take-home, 40% to needs, 52K to 56K, housing, food, utilities, transportation, insurance, 20% to wants, 26K to 28K, dining out, entertainment, hobbies, travel, 40% to savings and investment, 52K to 56K, retirement accounts, taxable investment, emergency fund, house down payment. If you're saving 50K plus per year and investing it at 7 to 8% returns, you're building serious wealth. After 5 years, 300K, after 10 years, 750K, after 15 years, 1.4 million, after 20 years, 2.5 million. That's millionaire territory by just being disciplined with a 200K income over time. But here's where most people fail: lifestyle inflation. As soon as they start making more, they upgrade everything. Bigger apartment, nicer car, more expensive restaurants, luxury vacations. Look, I'm not saying live like a monk. Enjoy your money, but be intentional about lifestyle inflation. Maybe upgrade 1 or 2 areas of your life that really matter to you, but keep everything else relatively constant. For me personally, when my income jumped, I upgraded my housing because I value living in a nice space, but I kept driving the same car for another 4 years, and I didn't really change my spending on clothes or entertainment. That allowed me to save most of the increase. The investment priority waterfall. Here's the order you should prioritize your savings. 1. Emergency fund first. 3 to 6 months of expenses in a high-yield savings account. This is your security blanket. Don't skip this. 2. 401k up to match. If your employer matches 5%, contribute at least 5%. That's free money, 100% return immediately. 3. Max out HSA if you have a high deductible plan. $4,150 for individuals, $8,300 for families in 2024. Triple tax advantage, you can't beat it. 4. Pay off high-interest debt. Anything over 6 to 7% interest should be paid off before investing more. Credit card debt, personal loans, etc. 5. Max out 401k, the full $23,000 limit in 2024. This is huge for tax savings and retirement building. 6. Backdoor Roth IRA, $7,000 per year in 2024. Tax-free growth forever. Google Backdoor Roth IRA if you're over the income limit for regular Roth contributions. 7. Taxable brokerage account. After you've maxed tax advantage accounts, invest in a regular brokerage account. Index funds, ETFs, diversified portfolio. And 8. Real estate or other investments. House down payment, rental properties, angel investing, etc. Only after everything above is handled. If you follow this waterfall at 200K income, you're maxing out retirement accounts, about $35K per year, plus investing another $20,000 to $30,000 in taxable accounts. That's $50,000 to $65,000 per year going toward wealth building. The asset allocation strategy. For most people at this income level with 20 to 30 years until retirement, a simple 3-fund portfolio works great. 60 to 70% U.S. stock market index, VTI or similar,
20 to 30% international stock market index, VXUS or similar, 10 to 20% bond market index, BND or similar. Adjust the bond percentage based on your age and risk tolerance. Younger, fewer bonds. Closer to retirement, more bonds. Don't try to pick individual stocks unless you really know what you're doing. Don't day trade, don't time the market. Just consistently invest in index funds and let compound interest do its thing. I know this sounds boring. That's because it is boring. But boring works. Exciting investing strategies usually lose money. The real estate decision. Should you buy a house? Maybe. It depends on your situation. Buying makes sense if you're planning to stay in one location for 5+ years. You have a 20% down payment saved. Your mortgage payment, including taxes and insurance, would be less than 30% of your gross income. And you're ready for the responsibility of maintenance and repairs. Buying doesn't make sense if you might move in 2 to 3 years, you don't have a down payment saved, you'd be house poor, spending more than 30% of income on housing, or you'd rather invest the money in the market. Personally, I think at $200K income in most markets, you can afford to buy if you want to, but don't feel pressured to. Renting isn't throwing money away if you're investing the difference. The side income multiplier. Once you've built your career income to $200K, consider building side income streams, not because you need the money for expenses, but because additional income can be directly invested for faster wealth building. Examples: consulting in your field, $200 to $500 per hour, teaching or coaching, $50 to $200 per hour, creating digital products, courses, templates, tools, rental income from a property, dividend income from investments. If you can add $20,000 to $40,000 per year in side income and invest all of it, you're accelerating your timeline to financial independence significantly. The financial independence number. Here's a useful framework. Your FI number is roughly 25 times your annual expenses. If you need $80,000 per year to live comfortably, your FI number is $2 million. At that point, you can withdraw 4% per year, $80,000, and historically your portfolio shouldn't run out of money. If you're saving $50K per year and getting 7% returns, hit $1 million in 13 years, hit $2 million in 21 years. So if you start this at age 30 making $200K per year, you could be financially independent by age 51, or by age 43 if you're more aggressive with savings. This doesn't mean you have to retire, but it means you don't have to work. You have optionality. You can take a lower-paying job you love. You can start a business. You can take a year off. You have freedom. The tax optimization layer. As your income and wealth grow, taxes become one of your biggest expenses. Some strategies to minimize them. Max out all tax-advantaged accounts, we covered this. Tax loss harvesting in your taxable accounts, selling losers to offset gains, bunching charitable donations in high-income years, holding investments long-term for capital gains treatment, 15 to 20%, instead of short-term, ordinary income rates. And consider location. Some states have no income tax. Texas, Florida, Washington, Nevada.
For complex situations, hire a CPA. A good CPA can save you way more than they cost. The insurance protection. As your income and wealth grow, you need to protect it. Life insurance if you have dependents. Term life is usually best, not whole life. Disability insurance to replace your income if you can't work. Critical if you're the primary earner. Umbrella liability policy. $1 to $2 million coverage, costs like $200 to $400 per year. Adequate health insurance, high deductible with HSA if you can afford it. Don't go crazy with insurance, but don't skip the essentials either. All right, we're about 2 hours in now. Before we wrap up, let me give you that big reveal I promised at the beginning. Chapter 10, the career move nobody talks about, the strategy that's worth $40,000 to $60,000 to your total comp. Okay, here it is. The strategy I've been building up to. The move that can add $40,000 to $60,000 to your total comp, and most people never consider it. It's this. Become a pre-IPO startup employee with strategic timing. But not just any startup, and not at any time. Here's the exact playbook. Step 1. Get to $120,000 to $150,000 first.
You need to build your skills and credibility first. Don't join a startup when you're at 60K because you'll be underpaid and you won't have the credibility to negotiate a good equity package. Step 2. Target Series C or D startups. Not too early, too risky, not too late, equity value already captured. Series C or D means they've proven product market fit. They have real revenue, but they haven't IPO'd yet. Step 4. Look for companies with these signals. Raised $100 million plus in total funding. Revenue growing 80% year over year. Well-known top-tier investors, Sequoia, Andreessen Horowitz, Benchmark, etc. Experienced CEO who's done this before. Path to IPO within 24 to 36 months. Ask directly in interviews. Step 5. Join as a senior IC or manager. You want enough seniority to get meaningful equity, 0.1% to 0.5%, depending on the company's stage, but not so senior that you're all politics and no execution. Step 6. Negotiate hard for equity over cash. This is counterintuitive, but here's why it works. Your base might be $140,000 instead of $160,000, but your equity might be $80,000 per year on paper. If the company IPOs and the stock does well, that equity could be worth $150,000 to $300,000 per year. Let me walk through a real example. Sarah joined a Series D startup in 2019. Base $145,000. Could have gotten $165,000 at a public company. Bonus $25,000. Equity 0.25% of the company, 4-year vest. Total comp on paper $220,000 with equity valued at $50,000 per year. She gave up $20,000 in base salary compared to a public company offer. Company IPO'd in 2021 at a $4 billion valuation. Her 0.25% became worth $10 million on paper. After dilution, vesting schedule, taxes, lockup period, and selling over time, she netted about $3.2 million over 4 years. That's an extra $800,000 per year on average. Her effective comp was $970,000 per year for those 4 years. Obviously, this is not guaranteed. Lots of startups fail. But if you follow the criteria I laid out, Series C or D, strong signals, clear path to IPO, your odds are much better than random. And here's the key. You only need to do this once. Hit one pre-IPO company that does well, and you've built wealth that would take 10 to 15 years to build otherwise. Step 6. Diversify after the lockup. When you can finally sell at least 50 to 70% of your shares. Don't hold everything hoping it 10x's. Lock in your gains, diversify into index funds, and you've got your financial foundation. Step 7. Leverage the brand and wealth. Now you've got a successful startup on your resume and you've got money in the bank. Your next move? You can either join another pre-IPO company and try to repeat, higher risk, or take a comp maximization role at a public company, $250,000 to $350,000. Or start your own thing, you have runway now. Or take a step back to a less demanding role because you don't need the money as much. This is the strategy that's created most of the wealth for people I know in tech. Not getting $5,000 raises every year, not slowly climbing the ladder, getting into the right startup at the right time with meaningful equity. Now, I know what you're thinking, but I'm not in tech. This doesn't apply to me. Actually, the principle still applies in other industries. Join a high-growth company before it becomes huge. Negotiate for equity or profit sharing. Ride the growth wave for 3 to 5 years, cash out, and leverage the experience. This works in finance. Join a hedge fund or PE firm before it's established. Earn carried interest. In real estate, join a developer before they're huge. Get profit sharing. In consulting, join a boutique before it gets acquired. The key is identify companies on a growth trajectory. Get in before the value is fully captured, negotiate for upside, and time your exit well. Now, why don't more people do this? 3 reasons. Risk aversion. People prefer the safety of a steady paycheck at an established company. I get it. But remember, the biggest risk might be never building wealth. Lack of awareness. Most people don't know how to identify pre-IPO companies with good prospects. They don't know how to evaluate equity packages. They don't know this strategy exists. Poor timing. They try this too early in their career, not enough leverage to get good equity, or too late, the companies they can get into are too early stage and risky. The sweet spot is 5 to 10 years of experience, strong skills, good network, financial stability so you can take some risk, and strategic targeting of Series C and D companies. How to execute this if you're interested. 1. Build your skills to $120,000 plus level first. 2. Start following the startup ecosystem in your industry. 3. Set alerts for Series C and D funding announcements. 4. Network with people at these companies. 5. When the right opportunity comes up, interview aggressively. 6. Negotiate hard for equity, more important than base. 7. Perform extremely well for 2 to 4 years. 8. Diversify and capture the gains. This is what I've seen work consistently for people who've gone from $120,000 to $300,000 plus total comp in just a few years. Chapter 5. Your personal action plan. The next 90 days, the next 12 months, the next 5 years. All right, we've covered a ton. You've been watching for 2 hours, and honestly, if you've made it this far, you're already in a different category than most people. Most people consume content but never act on it. You're different. You're still here, which means you're serious.
So let's bring this all together into an actual action plan, because information without action is just entertainment. If you're currently at 60K to 80K, your next 90 days. 1. Calculate your current total comp. Base plus bonus plus benefits plus equity. Write it down. 2. Research market rates for your exact role and location using levels.fyi, Glassdoor, PayScale. Know what you should be making. 3. Identify your top 3 skills. 1 operational, 1 technical, and 1 leverage skill you want to build. 4. Start documenting your work in terms of business impact. Create a brag document where you log every accomplishment with numbers. 5. Set up job alerts for roles at companies that align with your strategic career goals. Not applying yet, just watching. Your next 90 days. 1. Build 1 high-value leverage skill. Business case analysis, basic people management, strategic communication, or a hot technical skill. 2. Complete at least 2 high-impact projects at your current job that you can quantify. Saved X dollars, increased efficiency by Y%, reduced errors by Z%. 3. Network with 10 people who are where you want to be in 3 to 5 years. LinkedIn coffee chats, industry events, whatever works. 4. Apply to 15 to 20 companies strategically, not spray and pray. Target a 20 to 30% comp increase. 5. Interview at 3 to 5 companies even if you're not desperate to leave. Practice your negotiation skills. 6. Make at least 1 job move that increases your comp by 15K plus and improves your skills, brand, or title. Your next 5 years. Move from 60K to 100K through 2 strategic job changes. Build both technical depth and leverage skills. Get at least 1 brand name company or fast-growing startup on your resume. Start investing 20 to 30% of your income consistently. Build a network of 50-plus people in your industry. If you're currently at 80K to 120K, your next 90 days. 1. Assess which leverage skills you need to develop to break 150K. People management, strategic thinking, executive communication, cross-functional leadership. 2. Identify 5 to 10 companies known for paying well in your field. Use levels.fyi, talk to recruiters. 3. Update your resume and LinkedIn to highlight business impact, not just responsibilities. 4. Research equity compensation thoroughly. Understand RSUs versus options, vesting schedules, and tax implications. 5. Start having conversations with your network about opportunities. Don't wait until you're ready to leave. Your next 12 months. 1. Either get promoted at your current company with 15+% raise or make a strategic move to a new company for 120K to 140K total comp. 2. Build expertise in a high-value area that's in demand. Data analytics, AI ML, cloud architecture, strategic finance, growth marketing, etc. 3.
Get involved in at least one high-visibility project that involves multiple teams or departments. 4. Start maximizing tax-advantaged accounts, 401k, HSA, backdoor Roth. 5. Build relationships with 3 to 5 recruiters in your industry. 6. Consider getting a certification that's valuable in your field if applicable. Your next 5 years. Move from 100K to 180K plus through a combination of internal promotions and external moves. Position yourself for roles with meaningful equity, 10 to 30% of total comp. Build a strong professional reputation in your niche. Save and invest 30 to 40% of your income. Hit 200K plus total comp by year 4 or 5. If you're currently at 120K to 150K, your next 90 days. 1. Decide if you want to optimize for comp maximization, equity upside, or work-life balance for your next phase. If equity upside is interesting, start researching Series C and D companies in your space. Calculate your FI number, 25 times annual expenses, and map out a wealth-building plan. Identify gaps in your executive presence, communication, strategic thinking, influencing without authority. Review your network. Do you know enough people at the director, VP, or C-suite level? Your next 12 months. 1. Make a strategic move that gets you to 180K to 220K total comp with at least 20 to 30% from equity. 2. Build executive-level skills, business strategy, financial acumen, organizational design. 3. Start building a personal brand if relevant, writing, speaking, visible projects. 4. Max out all tax-advantaged accounts and invest aggressively in taxable accounts. 5. Consider the pre-IPO strategy if the right opportunity comes up. 6. Build relationships with senior leaders who can open doors for you. Your next 5 years. Hit and sustain 200K plus total comp. Build net worth to 500K plus through disciplined saving and investing. Position yourself for potential 300K plus roles or significant equity outcomes. Develop expertise that makes you one of the go-to people in your specific niche. Create optionality through wealth building and reputation. Universal action items, regardless of current level. Financial actions. Set up automatic transfers to investment accounts, 401k, IRA, taxable brokerage. Create a monthly budget that tracks your savings rate. Build or maintain a 6-month emergency fund. Review and optimize your insurance coverage. Work with a CPA if your situation is getting complex. Career actions. Keep your LinkedIn updated with recent accomplishments. Update quarterly. Maintain relationships with recruiters. Respond when they reach out, even if not interested. Read at least 1 to 2 industry-relevant articles or books per month. Attend at least 2 industry events or conferences per year. Have informational interviews with people in roles you aspire to.
Skill development actions. Spend 3 to 5 hours per week on deliberate skill building. Work on one leverage skill per quarter. Document your learnings and results. Share what you're learning, writing, presentations, teaching others. Get feedback regularly on your growth areas. Network building actions. Reach out to at least one person per month for a coffee chat or call. Help others when you can. Introductions, advice, job referrals. Stay in touch with former colleagues. Join or create a peer group of people at similar career stages. Be generous with your knowledge and connections. Mindset actions. Remember that your worth isn't just your compensation. Be patient with the process, but aggressive with the actions. Learn from failures and rejections. They're data, not judgments. Invest in your mental and physical health, and celebrate wins along the way. Now, here's what I want you to do right after watching this. Action number 1. Open a document right now and write down 3 things. 1. Your current total comp. 2. Your target comp 24 months from now. And 3. The biggest skill gap between where you are and where you want to be. Action number 2. Choose one action from the 90-day plan that you'll complete this week. Not 5 actions, 1. Pick the most important one and do it. Action number 3, set a reminder in your calendar for 90 days from now to review your progress and choose the next set of actions. The biggest mistake people make after watching content like this is trying to do everything at once. They get overwhelmed, do nothing, and nothing changes. Instead, pick 1 or 2 high-leverage actions per month, execute them well, build momentum. Small, consistent progress beats sporadic, massive effort every time. Some real talk before we finish. This path from 60K to 200K isn't easy. It requires learning constantly, taking risks with job moves, negotiating when it's uncomfortable, working hard and smart, being patient but persistent, making strategic sacrifices, dealing with rejection and setbacks. But here's the thing, it's absolutely doable. I've seen hundreds of people do it. People who didn't have fancy degrees, people who didn't come from money, people who started in jobs making 40K to 50K and felt stuck. What separated the people who made it from the people who stayed stuck? They were strategic, they were intentional, they invested in themselves. They took calculated risks. They didn't wait for permission or perfect circumstances. You don't need to be the smartest person in the room. You don't need perfect timing. You don't need luck, which helps. You need strategy, consistency, and willingness to bet on yourself. A few final thoughts. Money isn't everything. I know people making 300K who are miserable and people making 80K who are happy. But money is freedom. It's optionality. It's security for your family. It's the ability to make choices based on what you want, not just what you can afford. So use the strategies in this video to get to your target number, whatever that is. Then focus on the other parts of life that actually matter: relationships, health, experiences, meaning, contribution. Because here's the ultimate truth. Your career is a marathon, not a sprint. You've got 30 to 40 years of working ahead of you. Play the long game. Build wealth steadily. Protect your health and relationships. Don't burn out chasing the next promotion or pay bump. The people who win long-term are the ones who are still in the game 20 years from now, still healthy, still learning, still growing, and who've built real wealth along the way. Final thing. If you found value in this video, please hit that like button and subscribe to the channel. It genuinely helps reach more people who need this information. Drop a comment below and let me know where you're at in your career journey and what your biggest takeaway was. And if you want to go even deeper on any of these topics, we've got other videos breaking down how to negotiate job offers word for word, understanding equity compensation in detail, the exact skill sets that companies pay for, how to make strategic career moves, building wealth on a high income. Check those out if you want to keep learning. All right, that's it. You've got the complete blueprint. You know what to do. Now go execute. Remember, the version of you that's making 200K plus is out there. They made different decisions. They took strategic action. They bet on themselves. You can be that person, starting today. Thanks for watching. Now get to work.